Does size really matter? We're talking storage here, so stick with me. Have you ever looked at a small storage deal and thought, is this even worth my time? Or should I just wait for a bigger one? Here's another question I constantly get. Hey, Alex, is this small storage facility a good deal? And my answer tends to disappoint people because it's usually, it depends. Not because I'm trying to dodge the question, but look, a good deal for a W-2 employee with 3 kids, limited capital, 0 experience is going to be very different from a good deal for an experienced operator, somebody who has capital connections, knows about storage. And so that's why it depends. There's a lot of variables and factors. But in this video and in this podcast, I'm going to be breaking down the pros and the cons of small storage facilities versus bigger ones. And I'm going to provide you with a very simple framework that you can use today and real stories of some of our Storage Wins community members who started small and it created a snowball effect. It created a lot of momentum for them. All right. So if you're on the fence about, hey, should I pursue a small deal, a big deal, or if you're just kind of chasing it all, I think this is really, really going to be helpful and insightful for you. And by the end of this, you're going to know exactly what you should be targeting for your very first storage deal. Okay, now let me go ahead and start with that question that I just touched on because I hear it all the time. Alex, is this a good deal? And my honest response is good for who? Okay, because it's impossible for me or anybody to answer that without knowing some additional factors. There's layers to that question. And one of the things I would encourage you to do is always filter any deal that you look at through your particular goals. Okay, what season of life are you in? What are you trying to accomplish with self-storage? I often hear that it's cash flow. Sometimes I hear, hey, Alex, I want to build a business for legacy purposes that I can pass along to my kids. You can have that all, but what is your primary aim and focus when you initially get involved in self-storage and you're looking to pursue your first deal? Many times it's people that I connect with that want to quit their job, right? They want to build a bridge. They want to be able to replace their income from their 9 to 5 through storage. And so for you, for others, that could just be, hey, Alex, if I could make $1,500, $2,000, $3,000 a month in cash flow, that can change a lot of things for me. That can really, really help. Okay, there's others I talk to that they want to go big. They want to build a portfolio. They want to build a storage empire. So what are your goals? Filter it through that. What season of life are you in? Are you super, super busy with family, with work, or maybe a business? Are you going through a particular transition? Are you just, what's going on in your life? Think about your resources. This is one of the exercises I always take somebody through when I'm working with them is we get crystal clear on where they want to go. Then we take stock and inventory of all the resources that they have. And these can be tangible or intangible resources, right? For some people, they have some capital and some money, and for others, they don't. Some have more time than others. Some have some relationships. Some have a unique skill set. For many, it's just, hey, I have a desire to win. I have a strong work ethic. So take stock and inventory of all the resources that you have that can help you on your storage journey and accomplishing and getting over the finish line on that very first deal. Think about your skills and your experience, right? Is this your first deal? Have you already done real estate deals in the past? Do you understand the operations of a business? This is where the buy box blueprint can really come in, okay? And this is one of our projects inside of our deal discovery process. When I created my first buy box, when I went through the buy box blueprint, like I believed in my head, I thought to myself, okay, it is going to take me just as much energy, time, attention, mental bandwidth to pursue a small 8 or 10,000 square foot facility as it is to pursue a 25, 30, or even 40,000 square foot facility. I just had a belief that bigger deals were also easier to fund because I've spent a while building relationships with private lenders and investors and wholesalers, people that I knew could come into the deal when I found the right one. I just had this core belief that if I got really, really good at finding the right opportunity and deals, the money would come. And there's a quote that says, the man or woman that thinks they can is right. The man or woman that thinks they can't is also right. It's fascinating to me that what the mind believes, things will start to open up for you to back you up on what your beliefs are. And that can serve you or that can pull you down. But that's not to say that you need to think big or go after a big deal. In fact, by the end of this, I think you're going to find that you're going to come to a conclusion. And that's the goal here, is to give you clarity. Because if you're new and if you're pursuing your very first storage deal and you don't have capital and you don't know anything about storage or you haven't really built a network yet, that's okay. And just know that starting with a small facility can be a fantastic way to get started. Because I would argue that, yes, of course, we want to get involved in the right deal, a deal that's going to make us money, and that could be cash flow, that could be future upside in equity, or it could even be a hybrid and a combination. Okay, we don't want to just get involved in any deal just to get involved in a deal. That's not what I'm saying. But I would also argue that the momentum, the confidence, the learning experience of buying a small facility is just as valuable as the income that asset can produce for you, the net cash flow that it might generate for you. And that's what today really in this video, in this episode is all about, is helping you figure out your path and your lane and where you fit. Because there isn't a wrong answer. It really just depends on you, your goals, and some of the factors I've just talked about. Now, before I start to get into comparing small versus big versus small, let's just quickly talk about why storage is such a powerful path, okay? And if you've gotten this far, maybe you don't even need to hear this, but I think it's important. With single-family rentals, you got one tenant. One tenant moves out and your income is gone. It disappears. With storage, you've got dozens, sometimes hundreds of doors. And so losing 5 customers, 10 customers out of 80, 90, 130 hurts way less than if you have a single family home and you lose a tenant, or if you have a duplex and you lose one, now half your income is gone. Okay. Plus, most of the upside in residential is based on the market going up. The value of homes is based on comparable sales. In storage, we get to do something called forced appreciation. In other words, we get to force the value through better operations, rent or rate increases, improving delinquencies and bad debt, streamlining expenses, charging different fee income, tenant insurance, late fees, admin fees, lock fees, things of that nature. Okay, we're not sitting around waiting for another comparable sale, another sale in the neighborhood on Zillow to pop up to hopefully help us out. So we get to force appreciation, and that's a huge, huge benefit that storage has over single family or many other asset classes for that matter. But let's now start to shift and talk about why small facilities, I believe, can be a perfect starting point for you, even though that is not necessarily the path I took. My very first storage facility was 43,000 square feet. It was 340 units, okay? But I have plenty of friends. I have people inside of the Storage Wins community that I have helped buy their first facility that started small. And I can tell you, the momentum they've built, the confidence they've gained, the education, real world experience, I would argue is just as valuable, if not more valuable, than just the income that you're able to generate from it. Okay. Now, a small facility, generally speaking, equals a smaller price tag. And so I think mentally it overcomes that hurdle for a lot of people. The fear or the belief that they need to have a lot of money or they can't get financing, or let's put that off to the side because that's not the purpose of this particular video and episode. But a smaller facility, one that comes with a smaller price tag, can make it easier for you, not just mentally, but using conventional financing, using an SBA loan. Usually with SBA, I think $500,000 is probably like the floor there in terms of the price point. But with SBA, which is the Small Business Administration, you can get a loan from them and come in with as little as 10 to 15% down. Sourcing money from a private lender on a smaller deal, I think sometimes can be easier because one private lender can potentially fund the whole purchase price, maybe two, depending. Creative financing is always an option, whether it's a small deal or a big deal. You can partner with somebody. A small deal, I think, is a good gateway deal. It's often the fastest path to actually getting in the game. And like I said, getting in the game is what you want to do. Now, hear me loud and clear. You want to get in the game with the right deal. You don't want to just get in the game with any deal. So, our promise when people come into our community is we're going to help you buy your first storage facility within 6 to 12 months. And many have been doing it in under 6 months. But it's not just your first deal. It's the right first deal. That's super, super important. And listen, so oftentimes people ask me, hey, Alex, how much money can a small facility generate? Or how much money can it make? I've seen small deals that can net $800 a month in cash flow to $1,500 a month in cash flow. Maybe even a little bit more, right? It depends on the size of the deal, depends on the market and other factors. And think about your particular situation. What would an extra $1,000 or $1,500 a month in net cash flow do for you? What kind of impact would that have? Would that take care of some car bills or groceries or education for the kids, or just take care of whatever? Like, that's going to help a lot of people. There's a lot of people out there that are struggling, and just a small deal, aside from the cash flow you can get, again, the confidence and momentum it gives you is far more valuable, in my opinion. And along those lines, for some people, it's just proof of concept. There's so many people that when they join our community, one of the instant things they get is a belief system and the confidence that you can do this. And you absolutely can do this. I mean, I've helped numerous people buy their first deal that had limiting beliefs, or they doubted their ability to do this. Can I do this? Does this work? And so proof of concept can be very, very important. Number two, small facilities. So let's talk about the upside here with these mom and pop smaller facilities. Small facilities are pretty much 100% of the time owned by mom and pop operators. In other words, a REIT, like a public storage and extra space, they don't own 10,000, 12,000, 15,000 square foot facilities, right? They're usually going 40,000 net rentable square feet and up. So when we connect with these mom and pop operators, oftentimes they have zero online presence, right? No website, no Google My Business listing. They have no Google reviews or weak reviews. They just don't understand business from an operations perspective. There's no a revenue rate management, poor collections, no marketing, no insurance revenue, no admin fees, zero automation. That's where you come in. That's where you can add value to the deal, generate more revenue, increase occupancy, increase the net income, the net operating income the business produces. And that's where the value comes. Okay. That's what has a multiple on the overall value of the facility in the business. So a lot of small facilities don't need a full turnaround. They just need someone to run it like a business, just to improve operations and streamline the way things are run. And that's one of the things that we help our Storage Wins members do when they take on a facility. In fact, just yesterday, we had our dedicated operations call where we talked about all these things. We talked about revenue rate management and operations and customer service and the things that you need to put into the facility that are going to help the facility generate more income, which increases the value. Let's talk about what happens when you buy a small facility, right? And this is where I want to highlight some of our Storage Wins community members, and this is just some of them, but Kate, as an example, who I interviewed, and she's on the Storage Wins podcast, and she's also that YouTube video recently came out, so you'll definitely want to check that out. In fact, we'll link it below if you're watching this on YouTube. But Kate came in with no money, very little confidence, tons of doubt. She ended up buying a small facility. In fact, the deal came from another community member who was wholesaling it to her, but she needed 30% into the deal, 30% down payment, which she didn't have. So she partnered with two other members, and that deal cash flows from day one, right? She learned the entire process of how to communicate and get the deal closed, going through due diligence, communicating with banks, lining up the financing. Now she's a better operator because she's actually operating the business. She had to go through the process of hiring a boots on the ground team member, managing them. Her confidence has completely skyrocketed. So much so to the point where she's under contract on I think it's a 20 something or 30 something thousand. I think it's a 31,000 square foot facility. She's under contract on that right now. I think about somebody who like KC, who owned a couple of rentals. He and I were at a mastermind, and we were walking in the woods in Oregon, and we started talking about his small rental portfolio. And on the back of that conversation, he decided, hey, I probably am better off selling these rentals, taking that equity and getting into a larger asset class. Well, he plugged into our process. He just went driving for dollars, right? Which anybody can do. Located his first deal in 91 days, his second deal 6 months later, his third deal, 3 deals in 11 months, all with creative financing, all driving for dollars, right? But that first deal, which was a small deal, I think it was like a 6 or a 7,000 square foot facility, that gave him the confidence to go bigger, to do more. Okay, Mario, same story. Started small. I think it's a 7 or 8,000 square foot facility. Made some mistakes along the way, learned from those mistakes, and has now used that deal as a springboard. That deal's already generating cash flow for him, right? And he's already working on the next one. So small deals give you reps. They help you build relationships. They give you the receipts. They give you the real world experience that you can build on. And that is everything. That combination is a complete game changer. Okay, now look, many deals can be run super, super lean, simple, without employees. You can run these remotely, so wherever you live. In fact, Mario, as an example, lives in Miami. His deal's in Missouri. Okay, Kate lives in Georgia. Her deal's in Illinois. Casey actually bought his 3 locally, but they're hours away. So he still would have to drive there. But whether it's in your backyard or hundreds of miles away, you can run and operate it lean, remotely, simple. You're not buying yourself another job here. Okay, handled correctly, a small facility really just takes a few focused hours a week, if that. I remember when I had my 2 storage facilities in Mississippi, which I've since sold, along with my Florida facility. So 3 facilities, I believe it was over 800 units. I think it was 104,000 net rentable square feet. That portfolio might have taken me an hour and a half to 2 hours a week. Okay, so with the right systems, processes, with the great boots on the ground, it can be run remotely, and you're not buying yourself another job here. Okay, now storage is an operator's business. There's revenue rate management. There's things that we do on a month-to-month basis. It is not passive. I think that is one of the biggest myths that people talk about. It's not buy a facility, set it and forget it. That's not what this is. And I want to be super transparent. But once you dial things in and occupancy is at a healthy place, it's pretty steady Eddie, right? It doesn't, like I said, 1 to 2 hours, a couple focused hours a week. And that's all it takes to manage these storage facilities, in my experience. Now, let's talk about some cons of small facilities, all right? And look, here's the truth. Small facilities come with some downsides too. And I think ignoring these is how people can get potentially hurt. Okay. When we think about the expense ratios in storage, the general rule of thumb is that the operating expense ratio, or the expense load, is usually between 30 and 40%, I would say on average. Now, the larger the facility, the lower the expense ratio. Okay, the smaller the facility, the higher the expense ratio, because you just don't have enough revenue. And so the operating expenses that it takes to generate that revenue is going to represent a larger piece of that pie. So when I'm looking at a small facility, I'd say 35 to 40% is pretty common. And I tend to underwrite, when I evaluate these opportunities, I tend to be a little bit more conservative. So if it's a facility that's definitely under 10,000 square feet, I'm going to lean closer to that 40% expense ratio. Okay. Remember, the expense ratio are the expenses that you need to incur in order to generate that revenue. Now, I oftentimes see storage deals that have, brokers are promoting it based on pro forma, meaning what it could do, what the future value would be. Sometimes I'll even see offering memorandums that have an expense ratio of 22% or 23%. Look, not impossible to achieve that, highly unlikely in most cases. And I'm certainly not buying a deal banking on a 20 or 25% operating expense ratio because I just have no wiggle room. What if it's 34% when I actually get into the deal? So if I can make the deal work at 35 to 40% operating expense ratio, I certainly know I can make it work with 25 or 30%, right? That's just more cash flow. That's just more money to the bottom line. So understand that with smaller facilities, the operating expense ratio can be a bit on the higher side. Also with smaller facilities, like one surprise, can eat up a larger chunk of that cash flow, right? If you have a gate repair, if you have an automated gate that goes down and you got to throw $1,000 into that, like that could chew up a month worth of cash flow. Or if you have a tax reassessment or a roof leak or a sudden increase in insurance, these are things to just be aware of, because when the revenue pie is smaller, the surprises can hit a little bit harder. All right. Now, let me address some common rookie mistakes when it comes to underwriting or evaluating these opportunities. Is I see sometimes people like leaning so heavily on a seller's expenses, and oftentimes the seller's expenses are tiny. Why? Because they manage and operate it themselves. Here's the thing though. Like I just said, we're buying these facilities not to incur another job. So when you buy a mom and pop storage facility, you are likely not going to run it yourself. I don't want you to be the boots on the ground. I don't want you to be making all the calls and handling everything and you're the maintenance person. Like, no, that's not what we want here. So sometimes I'll see rookies use the seller's expenses, underwrite the deal with those expenses, which could be 15 to 20%, right? Versus the 35 to 40% that we just talked about. They'll use the seller's taxes, not realizing that when they buy it, their taxes are likely going to go up. They might even use the seller's insurance when your insurance might go up, depending on what part of the country you're in, especially like Florida, South Louisiana, areas like that along the coast, insurance is going to be higher. Believing the seller's like, hey, I do this myself for free. But the seller, you need to explain to the seller that you are not going to do it for free. So you need to hire a boots on the ground person. If it's a larger facility, you might even get third-party management. If it's a smaller facility, third-party management is likely not going to make sense because the facility doesn't generate enough revenue to be able to afford third-party management. All right. So, and then underwriting too aggressively, right? Assuming a lower expense ratio, assuming that you're going to be able to do 15, 20, 25% rent increases when the market maybe can't support that. So whenever we buy a deal, we are not buying on the best case scenario. One of the things we talk about in our Storage Wins community is when we look at an opportunity, what's the worst case scenario? What's the likely scenario? And then what is the best case scenario? And we'll never buy on the best case. Oftentimes we'll buy if the deal works on the worst case, worst to likely. Okay. So something that I think can help you avoid getting into the wrong deal. And that's one of the things I find pretty often is a common objection people have is the fear of buying the wrong deal. Hey, Alex, what if I buy the wrong deal and I lose a bunch of money, or everything I've saved or I've built for like goes out the window because I bought the wrong deal? Part of our playbook and our process gives you the confidence to know that you are limiting the risk and we're avoiding any surprises, right? That's what due diligence is for. And we typically get minimum 30 days, if not 45 or 60 days, to dot the I's and cross the T's and to make sure that the business you are buying and the deal that you think is awesome is in fact that, okay? So here's my rule of thumb. And let me just kind of summarize all this. If it's a small facility and it still works at a 35 to 40% operating expense ratio or an expense load, some people refer to it as, we can talk. If the deal only works if the operating expenses are 20% or 25%, then I'm either out or I'm asking myself, what would make this a deal? That's a super valuable and important question you want to ask when you're looking at deals is, if it's not a deal based on the current price, what would make it a deal? And that could be a lower price. That could be creative financing like terms. Okay, remember, if a seller is going to control the price, I want you to control the down payment, the interest rate, and the term of the loan, the length of the loan. That's why seller financing can be so powerful. And I've created some videos and done some episodes just on that, which I would encourage you to tap into. Now, as we start to wind down here, like a great small deal could bring in $800 a month, $1,000, $1,200, maybe $1,500 or more. Is that amazing? Absolutely. What could that do for you? Is it life-changing? It depends, right? Now, is the deal itself going to allow you to retire and travel the world and do all the things you may want to do? No, of course not. But I would say it's life-changing in terms of the momentum, the energy, the confidence it gives you. Because there's a saying in storage that says, when you buy your first deal, you're halfway to 10. And for many people, it's that proof of concept. It's getting that confidence. It's knowing, hey, I can do this. So view small deals as your launch pad, not your finish line. Super, super, super important. And I don't want to just focus on small deals. Like for those that want to maybe go a little bit bigger. Like, when can a bigger deal make sense? And bigger facilities, generally speaking, they're going to have lower expense ratios, at least lower than a really small facility, are easier to operate at scale. They're going to attract more sophisticated buyers. They can command better valuation multiples when you go to sell, especially depending on the market you're in. Of course, there's no hard and fast rule here. This isn't a one size fits all. But this is where my own buy box came from. When I got started, like I shared, my belief was, hey, if I'm going to invest the time, energy, and attention, let me just focus on 20,000 square feet and up. All right. And that's what I found. First deal, 43,000 square feet. Second deal, 24,000 square feet. Third deal, 37,000 square feet. Okay. And that's not even counting the deals that I've wholesaled along the way. But it's interesting that what you focus on expands. And so there is no right or wrong here. Develop your buy box blueprint. And I have a video called the Simple Checklist where I encourage you to go through that so you can develop your buy box blueprint, because that will give you confidence and it'll start to kind of just give you a framework of what to focus on. All right. Now, I decided to go a little bit bigger because I had built some relationships. I had access to some private lenders, equity partners. I was planting my seed and dropping the breadcrumbs with everybody in my network. Here's what I'm looking for. Here's my buy box blueprint. And I ended up getting the right opportunity. So whatever it is, there are deals out there. Do not believe the lie and the myth that storage is overly saturated. Okay. Now, do we have to underwrite and look at more opportunities today than we did 4 or 5 years ago? Absolutely. And that's okay. There's always going to be deals out there. So don't get hung up on that. Okay. There's always opportunity out there. So let me leave you with a very simple framework to help you decide if you want to go big or if you want to go small for your very first deal. And here's the simplest way that I can explain to you to decide. Think of the 3 F's. Number 1, freedom, right? That's likely what you are pursuing self-storage for. Yes, it's money, but it's what is the money going to do for you? What is it that you want to do with that money? It buys you options. It gives you more time freedom, financial freedom. Okay, so what is it that you want over the course of the next 12 to 24 months? Are you in a W-2 and you want to replace part of your income or all of your income? Do you just want to feel more secure, build confidence? You want to quit your job? Do you want to start building a portfolio and you want to go big? So think about what you want storage to do for you. And you can accomplish it with a small deal or a big one. Now, if it's a small one, it might take more of them, and be okay with that. Or maybe you start small and then you graduate and you go bigger. Or maybe you're like, hey, Alex, you know what? I feel like I can go bigger. More important than whether you go big or small is finding the right deal that fits what you're looking for. Okay. Number 2, the second F, fuel. All right. What are you bringing to the table? Is it time? Is it money? Is it a network? Is it an experience? Is it a unique skill set that you have? Or is it just intangible? Like my work ethic, like I have the mindset that there is no way I'm going to quit. There's no way I'm going to stop, and I'm going to roll up my sleeves. I'm going to sweep the floors, so to speak, and I'm going to make this happen. So what are you bringing to the table? What do you have to contribute to be able to find the right deal? And oftentimes I like to encourage those that I work with is a better question is to ask who, not necessarily how or what. And I got that from Dr. Benjamin Hardy's book, Who Not How, one of my favorite books. It's probably somewhere behind me here, but the third F is foundation. All right. And foundation is like, do you want the lowest risk, simplest first step? Low barriers to entry. You don't want to you just don't want to risk much, just mentally speaking. Start small, okay? If not, and maybe you have some resources, or maybe you just have this mindset and this belief that you can go bigger, then open it up, go a little bit bigger. There isn't a wrong answer here, only what's right for you. So look, in closing, I want to start to land this plane here on this episode is small facilities can be an incredible entry point into storage. They can also be a trap if you don't underwrite them properly. The fundamentals and the principles still apply. I don't care if it's a 7,000 square foot facility or a 70,000 square foot facility. You want to buy right and you want to get involved in the right deal. That's where within our community, we give people the confidence, the tools, the resources, the help, the support, the guidance, and accountability to be able to get involved in their first deal and know they're not making a mistake. In fact, know that they're going to thrive. Now, bigger facilities can accelerate your path. They can also overwhelm you if you don't have that support I just touched on. If you don't have access to the capital or know how to get the capital, you don't have confidence, maybe you don't have any experience in business or operations. Those are not necessarily barriers that would prevent you from buying a big deal, but I would encourage you to find a community of people that can support you. Okay. I happen to be super biased. I would encourage you to check out storagewins.com, but that's neither here nor there. Look, the key is alignment here, and that's with your goals, with the season of life that you're in, your buy box blueprint. So here's my ask for you. If this has helped you, make sure that you hit subscribe. Okay, share this episode, share this video with another investor, anybody who's stuck, that's just not sure, that's floundering. I think this can be really, really insightful and powerful for them. And hopefully you have found that it's been there for you. Make sure that you're plugged into the Storage Wins podcast, onto my YouTube channel. And thank you for listening to me, watching me, hanging out with me today. I will catch you on the next one.